Hello, and welcome to Pro Trader Strategies Market Commentary for Thursday, August the 4th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Not a whole lot of economic data out there today. We did get factory orders that came in slightly better than expected, but it was a negative 1.5% versus the expected negative 1.8%. And then we saw a drawdown in natural gas inventories, which was a negative 6 billion cubic feet versus the expected build of 3 billion cubic feet. So that a little bit bullish for the natural gas side. On to crude oil. So crude oil yesterday, I was going back and forth with a couple of people. You know, if crude oil settled above the previous day's high, then I was going to be looking to exit out of my crude oil trade. I did. I will talk about that in a little bit. But basically that settlement above just really made it an engulfing candle, if you will, which just gives credence to the upside. Plus, on top of that, it settled above this Fibonacci level right here. So that $37 a barrel was kind of out the window, at least for the interim. It looks like it could just go straight back up to that $45 a barrel area. Onto the gold trade, or gold /GC, pushing higher today as well, up $4 on the day. Just can't really get through this area right here, about 1375, if you will, but that seems to be the major resistance area for gold. We get above that, the bulls could really push this much higher. The bonds pushing, you know, it's cats and dogs living together again right now. We got crude oil up, we got gold up, we got bonds up, we got equities up. Everybody's happy whenever all the markets are up. So right now everybody's toasting. One thing we have coming out tomorrow, which is the big one, non-farm payrolls, the unenjoyment number, as we used to call it on the floor. So could be a lot of jockeying back and forth today. As a matter of fact, earlier on today, we saw the equities that were in negative territory and have since pushed much higher, but bonds up over a point on the day. And as you can see on the equity front, we've got NASDAQ right here, /NQ, up 13 points on the day, but they were down here and negative on the day earlier this morning, right off the open for the most part. Same with the E-mini S&Ps, up on the day, /ES, just slightly though, almost 5 points though, but still stuck in this range. Looked like we were going to break it out of it and come down to test this value area high, but it's starting to get really comfortable in this area. But as you can tell, that rubber band getting wound really tight. So tomorrow, if that number is anything other than expected, we could see a big move in either direction. So be prepared for that and have your hedges on. This is the chart on the 15-minute breakdown for the E-mini S&Ps. As you can see, it's been pretty wild, despite the fact that we're right there, we're almost where we started the day off, but overnight just pushing even higher than where we are in the day session, and created this low to capture that overnight low, and now just rallied back off of nothing other than low volume and probably a lot of jockeying back and forth, trying to hedge up positions ahead of tomorrow's non-farm payroll. This is what I was talking about with XOP. If you remember, I got into this trade a little bit late. I covered my shorts a little bit earlier. It looked like once we broke below that $40 a barrel area, I was trying to play that down to $37 a barrel. We didn't get that. Yesterday's rally in the crude oil /CL just made me decide to get out of this XOP, cut my losses, pull the ripcord. I'm done with it. Back above that Fibonacci level, there's a lot of things going on there, and it went right back to the point of control here for XOP, which is where the most time and volume has been spent. It looks like we could either stay here or maybe push a little bit higher depending on how strong the bulls are. There's just a lot of oil out there. I just can't really see this going much back, or can't see /CL going up into the 50s, but I could see it, kind of tapering off and trading sideways here. So I just decided to cut my losses in this because I was long the September 31 puts. And I originally paid $1.06 for that, got out of it for 47 cents. So it was right around 50% of my debit that I paid. Decided to cut my losses on that. First Solar has had a massive sell-off since the open, but I talk about this. I actually tweeted out all my earnings trades last night right before the close. Of what I was doing in these particular underlyings for earnings. First Solar, I ended up going in there and selling the August 54 calls for 39 cents, and it actually was inside the market maker move for that on the open, basically unchanged. But since then, the euphoria has really fallen by the wayside, and it is tanking down to over $6 on the day. So probably could have held out for a couple more pennies. I bought it back for 10 cents. I bought it back for a dime. It's probably worth, maybe 1 or 2 cents right now. But, at the end of the day, I could have done that on the other direction. So don't want to play around with that. Kellogg was another earnings trade, and I went and covered this right off the bat in the first maybe even 5 minutes. I actually put these trades on before the open, where I wanted to get out, and got hit on most of them, Kellogg being one of them. I went into the August weeklies again, that expire on the 5th tomorrow, and sold the 77.5 puts for 55 cents in there, bought it back for a dime. This morning it really opened up right here, and that's about where I covered it. Probably could have again waited a little bit, made a couple more pennies, but it's not worth that in my eyes to risk a nickel to lose the entire profit that I made overnight. Tesla basically opened up right where we are again here, and has stayed inside the expected move for the earnings. And in Tesla, I just put on a strangle. August weeklies again that expire on the 5th. I sold the 250 strangle for 93 cents, bought it back for 9 cents this morning. Basically on no move, all that volatility came out of there, the theta decay, and all of that came in. One other one that I did, this earnings trade, as you can remember, was a bit of contention. They beat earnings, spiked higher. I had on a strangle. I had on the August weeklies that's expire tomorrow, and I sold the originally 96.5 strangle for 74 cents in there. The next day I covered my 91 puts for 3 cents, left on those 96.5 calls that I was short, and they were in the money. The market was rallying up, and I tried to hold off. Yesterday, I decided to roll those August weeklies out to the August monthlies that expire on the 19th for 72 cents. Now, hindsight being 2020, I might have been able to save myself a little or make a little bit more money on this trade had I waited till today, but I didn't want that risk of assignment. Somebody just putting those or sticking me with those calls and then being short the overall underlying if the market was going to continue to go higher. Now, had I gotten assigned those, it would have increased my deltas on the negative side, probably would have even made a little bit more money in that scenario, but that didn't happen, and I rolled it out luckily to avoid that. because I just didn't want to be assigned for one. And all in all, basically covered back those August monthlies for $1.18. So, you put it all together, I ended up making 25 cents on that trade. Had I left it in the weeklies, I might have ended up making 35 cents on the whole trade. But again, that risk reward on that extra 10 cents was not worth getting assigned, especially if the market was going to continue higher. The only way that would have been a godsend would be if the market, I got assigned, the market came down, because I would have been short 100 deltas versus short being about 80 deltas. So, and remember, when you're long deltas, short deltas, the delta is for every dollar move in the underlying is the change in price. So if I'm short 80 deltas, that means for every dollar move in the underlying, I would have been short, or I would have profited 80 cents. Had I been just short the underlying CVS, I would have been short 100 deltas, and that would have been dollar for dollar then on the downside. So just a little quick lesson on deltas and what your risk is there. But that's about all I got for you today. That's all the trades that I've done so far. Talked about the XOP, and Friday, tomorrow, we're going to be doing a webinar on the long call butterfly, or actually we're going to be doing long put butterfly tomorrow, and got a couple of great a couple of great underlyings that we're going to wrap around this strategy. So I'm going to go through all the rules as to how to build this up, because you can, believe it or not, build this strategy and have absolutely no chance of making money, absolutely no probability. I'm going to show how people can make that mistake and how to increase your probabilities of success with this particular strategy. All right, that's all I got for you today. If you can't take that, take it easy.